Good morning, everyone. Maybe just to confirm, can you all hear me? Can I get a thumbs up if you can hear me today? Okay, fabulous. Welcome to today's webinar. My name is Michelle Mafumbo, and I work at the Uganda Securities Exchange, and I'll be moderating today's webinar on interpreting financial reports for investment decisions. Maybe before we start, can we humble ourselves for a word of prayer? Dear Lord God Father, we thank you for today. We thank you for bringing us together this morning. May you please grant the speakers wisdom and clarity. May you guide us with confidence and calm as we go through this webinar. May you open the minds of every participant to learn and grow today as we have this webinar. May we understand what they are telling us. And may this hour be productive, insightful, and valuable to us all. In Jesus' mighty name we have prayed and believed. Amen. Okay. So we're going to start with a little game, an icebreaker, if you may. Maybe just allow me to share my screen for a bit. Can someone please confirm for me if they can see my screen? So for this game, I'm going to just request you to scan the QR code and answer the questions on your screen. Don't worry, it's totally anonymous. You have 60 seconds for every answer. These are very interesting answers. Okay, so we're going to move to the next question. Why do you think it's important to know how to interpret financial reports? Just write your answers and press submit, and we should be able to see them. You should be able to see your answer on the screen. I like these answers. Very insightful. That's true. Okay. So we're going to go to the next question. Have you ever seen a company's financial report before? Okay, okay, okay. Someone said no. Okay. And when a company tells you it made 10 billion in profit last year, what comes to mind? Okay. Okay. I'm glad someone is asking, can I trust that number? All these questions will be answered today. And then maybe lastly, what is something you'd like to walk away with from today's webinar? Just type in your answers and we should be able to get a glimpse of that as well. Okay. Okay. So many of you are in the right place. You are in the right place. A cheat sheet to understand financial statements. Okay. Okay, okay, okay. Okay, thank you so much for participating in this short game. We are so happy to hear from you. We're happy to know what you'd like to learn today. And let's just get into the webinar right now. So for today's webinar, we have the honor of having some very experienced people talking to us today. We have Isaac Kayemba. He's a revenue and financial analyst at the Uganda Securities Exchange. He'll help us understand what a financial report actually tells an investor. Isaac, you're welcome. We also have Calvin Bateme. He's the team lead at Crested Capital. He'll be explaining to us why ordinary investors avoid financial reports and later have a walkthrough of an annual report to help us understand that better, more practical. And we also have Dale Sendagire. He's the manager investor relations at Stanbic Uganda Holdings. He'll be able to give us the insider perspective on how Stanbic communicates with its shareholders and more into that later. So maybe just before we get into the thick of things, would like to have some insight on why investors avoid financial reports altogether, despite them being very important. And maybe Isaac can give us some insight into that with some short questions. Isaac, first question for you. Financial reports can look intimidating for first-time investors and people without a finance background. How would you describe a financial report and what does it tell an investor? Okay, maybe as we wait for that response, there's another question coming in for Isaac. Sorry, for Calvin. Calvin, as a broker who reads company financials regularly, why do you think most ordinary investors avoid them?
Good morning, Michelle. I hope I can be heard on your end.
Yes, you can.
I don't know whether I had prepared a presentation for the team. I don't know whether I can share and I will go through this entirely before the other team comes on. Is that
Calvin,
okay?
before you present, may you
Yes,
we
ma'am.
just had a short question about why ordinary investors avoid reading
Financial.
financial reports before we get into the presentation. Just a short question.
Oh, okay. Basically, I could take it to three things that can off the tips of my fingers. One is most people fear numbers, as we've all been in class and we've been at school, and mathematics was not kind to most of us. So this has it has been inherent even with the numbers as investors. So if you look at an annual report, basically it could be about 300 to 200 to 300 pages, and most people don't want to look at very many numbers. So the fear of numbers comes out as one thing that people don't want to actually look at. If you tell them to analyze some things, and they will not look at it because of that. Then two, the unfamiliar language in the reporting, because most of us don't have an accounting background. So with that in mind, they just avoid things like amortization, provisions, impairments. So what does all this mean? So with that, people just avoid reading them entirely and maybe wait for someone to tell them that this is how much you'll get, or this and then also the other thing I could talk about is that it takes too long. Yeah. Some people think that analyzing a report requires you maybe take off like a week to analyze a report. Yet, simply you can just get in the papers and look at things here and there, and you know how the company has performed, how much it has made, and the like. Thank you. Maybe that in simple terms, I could describe that in that way.
Oh, okay. I
Yes.
absolutely understand. When people see numbers, it can be scary. The team seems to say they can't hear us. Can you hear us a little louder now? Can I get a thumbs up if you can hear us? Matthias, can you hear us now? Yes or no? But that's a fabulous answer, Calvin. I can totally relate. I can imagine what it would mean for someone who fears numbers to see a financial report and they're seeing all these new terms as well. But you're going to help us understand that today, isn't that right?
We're going through the nitty-gritties of what exactly should you look out for when presented with these numbers, and we see how best we can going forward, how our investors on the call can go through these financials and make meaning out of them and make informed decisions.
Okay, that's fabulous. Thank you so much, Calvin. Calvin is going to give us a step-by-step walkthrough on how we can now navigate financial reports. Calvin, over to you.
Thank you, Michelle. I think I can display my screen. Just a minute. Please let me know if you can see my screen on your end.
Can we just have a thumbs up to confirm? Fabulous. There we go.
Okay, so we are going to basically I try to do reading company financials with confidence that we can see how we can better ourselves, and we are going to focus on SBU, that is the ticker for Stanbic Uganda Holdings, and we are focusing on the 2025 annual report that was released recently. As I started in the beginning, these are the few areas where that people look at and have phobia for numbers. If I could use that language of phobia, people have phobia for numbers, but it's not something that we've not, as humans, there are things we like and things that we don't like. So basically for numbers, this is what I picked out that makes people fear. As I had already gone through that, I won't waste more time with that. Then focusing on the statements themselves, majorly there are three. Yeah, there are three statements. And for starters, we begin with the income statement, which is also called profit and loss. And in this, a shareholder or an investor looks at an income statement to know whether money has been made by that company, basically. And as you can see to your far right, I explain it as, think of it as like a pay slip. It shows what the company earned, what it spent, and whatever there was anything left at the end. Yeah, because it is just a trickle down effect that this is what was made. We are lessing these expenses and the like. So you get the bottom line there, which is the net profits, how much money has been made. And for Stanbic, they made a net of 550 billion in that financial year. And I usually ask my investors that of the 550 billion, how much is yours? And that should always guide your investment in the coming year, in the quarter. Of that much, how much is going to be yours? And as we proceed in the presentation, you will see that how are you able to know how many dividends you've earned and how would you get them and how would you be charged and the like. The other key statement is the balance sheet. And this one looks at what the company owns and who demands it, or what is owed as a company. And also, some people call it a balance sheet, statement of financial position, because it's just showing where are you exactly, what is it. If we look at it in terms of a house, things like a TV, your radio, your seats, those are your assets. Because in financial terms, if you come back to the bank essence, is that an asset is anything that will generate you money. That is what we call an asset. But in real terms, this is your property, and you can use your property as anything. It can either generate you money or an aid to make you money. Then you look at liabilities. Those are things that I would consider them not yours, but you're keeping them for other people. If you look at liabilities like money deposited in the bank, money you borrowed, the bank has borrowed, and the like. So those are liabilities. Then equity is simply the thing that you've totally earned, and they're yours. For the bank side, you look at On the equity side, you look at maybe retained earnings. Remember, when a company makes this 550 billion, not all that money is given out, but some money is retained in the bank for future investments and the like. So that's why you see things like reserves and the like in on the balance sheet. So those make up the equity statement and what the shareholders actually. And then the cash flow statement is basically all called the stats, just changing wording, statement of cash flow. The real actual the movement of the cash in the business. How is it coming in and how is it going out? Yeah. For the total assets on the balance sheet, it is important to note that for investors, note that Stanbic is the biggest bank in Uganda by asset size. So it is 11.5 trillion Ugandan shillings. So it's the biggest bank by asset in Uganda as of the recent. It has been the biggest, I think, for the last a couple of years with I think centenary coming around with 9 trillion, I think around that figure and more. And the three listed banks in Uganda are I think in the top 5 or top 8. So I could say that this market is well positioned since we have those big banks listed on the USA, and that's kudos to the team. And we should look into because they are making good money. So if you are looking for portfolio to make, at least have one of the banks on your side as listed. Yeah. And if you're looking for these income statements in the Stanbic report, you'll go to page 47 to 90. That's where you'll get these income statement, balance sheet, and cash flow statements. If I may proceed. Then looking specifically into the income statement, what does the income statement entail? Yeah. And what does it tell you about the company? Total revenue, yeah. Stanbic made a tune of 1.11 trillion, and this is money earned from all the company operations, the loans they bought, and every activity. So take it like from the sales they made a total of 1 trillion. But from that, because they have to expense what they have to operate on a daily, so they what we call operating expenses. Those are the costs of running the business, paying staff, paying rent wherever they have a motor, having ATM machines working, producing the ATM cards, and all those nitty-gritties. And that came to a total of 677 billion for that particular year. And there are some things called impairments. Those are losses on loans given out. This is just money set aside that in case some of the non-scrupulous borrowers along the road, this money will cover that for the bank, and it was in the total of 18 billion. And this is just a safeguard for any bank. And in most cases, if these impairments are growing year on year in, then there's a problem in the loan book of that company. But I think with 18, it's relatively okay for the bank. But if zero is attainable, then it's better to have zero impairment. Then you remember we have a taxman in Uganda who collects from everyone. I believe it is in every form of business has tax or to them, and that was they paid to. And Stanbic is one of the highest taxpayers in the country. Kudos to them, and a tune of around 152 billion given back to government to do roads and everything, and pay civil servants. And they close with a net. Yeah, what is left after all that's reduced is 550 billion, as we said in the beginning. Hope we are following properly. I'll have questions at the end. Then what is in a balance sheet? As I said, the accounting equation is assets equals liabilities plus shareholders' equity. Yeah. And on the asset side, what does the bank own? Yeah. That is the customer loans, government security. Those are investments, the cash and reserves at the Bank of Uganda, the building and equipment, and all that. There are very many, but I just picked out these because there are some things like intangible assets and like the forms of software, and also all those belong to the bank. That's all bank property. But one thing I have clarified that being a shareholder, in most cases, people think that if you're a shareholder, and since you own the business, you're able to just maybe walk into any Stanbic branch and start commanding and doing what. Actually, we don't. As a shareholder, you just have a financial interest in the business, not in its assets. Since you gave away that management, you gave the board and management power to have all this taken care of. So the assets are to a tune of 11.5 trillion. Then liabilities. What the bank demand? What is not for the bank? The customer deposits at around 8 trillion, and that's good. Borrowed funds are in there, taxable income and other obligations, all incorporating all the liabilities. Then how has the equity side grown over the years? That the capital shares, retained earnings, those are part of the past profits that have been earned and reserves, and that's to a tune of 2.3 trillion as a shareholder equity, and it's a good book to look at. Then those are the three statements. Then if you are analyzing a bank, we picked out two key ratios that you maybe look at. You shall look at return. What's the return to your equity as the shareholder? Because remember, I said what do the shareholders own in the business is the equity, and the more that business that side grows, the better for the shareholder in that they are growing. And the return on equity is just the net profit divided by the number of shares that the company has. That is and I explained it here a little. If you invested 1,000 shillings in a business, how much profit did that business generate for every 1,000 shillings that you put into that? And for Stanbic, for every 100 shillings that invested, they get 25% back, and that is a very good return in ROE to investors. Then the other key ratio you look at is the earnings per share, or the EPS as we may call it, and this is looking at you look at the net dividend divided by what would you actually get, given that all profits were given back to shareholders. Remember, part of the profits is retained in the business, yeah. And if you look, Stanley gave a dividend, I think of in the last, it was 7. In the last quarter, that was 7, and with the EPS of 11, so you see that it's not way far off of what they made. So literally, that is a very good return to investors in terms of the EPS in the comparison to the EPS that is in the business. Then another key thing to look at is the dividend as a shareholder. In total, Stanbic gave out a total of 360 billion. And remember, I posed the question to you that how much of this is yours as a shareholder? Yeah, DPS. How do you compute DPS? A dividend, as it's mentioned, it's dividend per share. So for every share you own, you'll be paid a certain amount of money to you. Yeah. So dividend per share will be computed. So every year, every time the company releases financials, they are going to declare, board declares a dividend that is approved by you, the shareholders of the business. If you do not approve it, then it's not paid out to you as investors. But I've not seen this in Uganda. Every time the board recommends, it is paid. Only that for Stanbic, post-COVID, they require approval from the central bank to have this dividend paid. For all banks, they get approval to pay. So that's why that you've seen a delay in when the book closure and the like. But I think Dale will tell us more about when we expect the central bank to release that money and when we should expect it paid to shareholders. The key dates to look at is the book closure date. They pay the ex-div date. An ex-div date is the date you have to trade, the last date you trade on for you qualify for a dividend. But how do you get the number of the dividend paid to you? It's just a matter of multiplying the number of shares you have and the dividend that is declared. Yeah. When you receive it is when that date is always given in the financial statements or in a public notice that is always put out by the company in the newspapers, on their website, and often sent to you by your share registrar on your emails. Then looking into the bank's operations, one key one is consider is the deposit to loan. Remember, all the deposits we take to the bank, what does the bank use them for? Some money is used for onward lending to clients. Some money is invested like that. So this ratio is very important, because if all money deposited is equivalent to the loans, then I think there's a problem, because you will not have money maybe for withdrawing and for onward lending. Not for onward lending, but for withdrawing, given that people come, because people pick money as and when they feel like. So this ratio is very important, as I highlighted there, that many banks could, if you look at the financials of the commercial banks, they've lent about 80 to 90% of their, but Stanbic is currently at about 68% on number of loans in comparison to the deposit, which is a little bit very good since they have other cash somewhere else that they are using us on their particular loan book. So a growing loan book is good. If you don't have very many non-paid loans, then a big loan book is good too. But if you have a big loan book and again people are defaulting on those loans, then it become too dangerous since the money you're using is for the customers. So when customers come to withdraw this money and it's not there, it may not be very good for the what? For the bank. If a case to look at is I think it was Family Bank in Kenya, whereby one depositor came and withdrew money and the bank did not have any other money. So you should also look at maybe this is much into banking, how much money is kept in for onward lending, how much money is left in as cash reserves for withdrawing and the like. So as the bank hires people, they have to look at all these. Then how do you know how much you've earned? There are various ways in which you actually most likely two ways in which you earn from your shares that have been invested in. One is the capital gain, which is the difference between the money you've the shares you bought, the price you bought at, and the price at which you sell at. Usually, I say that you only lose in the stock market when you sell. If you don't sell your shares, you don't lose because that price can always go back even above the one you bought it at. Case in point, if I may, we are focusing on Stanbic, but let me use another listed entity. Let us say Airtel Uganda. Airtel listed at around 100 shillings, and effectively every shareholder paid about between 96 to 98 shillings, given the discount on how much you bought in that particular IPO. So this price went down and now is back up, so above 100%. So if you sell currently and the only time you had bought was the IPO, it means you've earned a capital gain to this. But always remember that there's a commission charge to that. So always less 2.1% on every trade that you made in the market to get your net capital gain. Then the other one is the dividend that we've been looking at. What dividend has been paid by the company to you? So you just simply multiply that by the number of shares that you own, then you less the taxman's money, which is the whole tax. That is 10% for Ugandans and 15% for non-Ugandans. So you always have those charges incorporated. Then the total shareholder return, just add the two, and you see if you sold after gaining. A TSR is just a paper return, but it's only attained if they paid your dividend, then you sell off your shares. That's when you'll be able to clearly know how much you've earned in and as the shareholder return. If I may proceed, this is just your action, what you should do after here. You can download the Stanbic numbers, have a look at them. They are available on their website, even the USE website, they're there. Or you can email us at info@presetcapital.com and we can email them to you. You could look out for these key metrics that we've looked at, the EPS, the ROE. And if you're on the call and you've not yet opened an SCD, we've gone digital now. You can dial *165 *6 hash and you open it on your Airtel on M10 line or 185 *85 on your Airtel, or you can email us at Preset Capital and we shall always get back to you with account opening forms to open this account and you start your investment journey. Thank you for listening to me. Back to you, Michelle.
Thank you so much, Calvin. That has been very insightful. I'm sure all of us now have ideas on what metrics to look out for when it comes to financial reporting. How do we make money? How do we know whether we are making money or not? He has said you only lose in the stock market when you sell, and you sell at a lower price than you bought. Now, maybe just to get into now the main discussion, we just have a few questions for the panelists. Maybe to start with Isaac. Isaac, can you please explain the difference between revenue and profit and why a company can have a high revenue but still disappoint investors?
All right. Thank you, Michelle. And very good morning to our listeners on the call today. So I think as Calvin shared earlier, an income statement gives you a story really of how the company is making money, but also spending that money. And the primary metric that you're going to use to measure how much a company is making is their revenue. Now, that revenue is over a period, maybe a year, maybe 3 months, maybe half a year or 6 months. And of course, it comes from contracts with customers and the like, or services that they provide. And in this case, Stanbic would be providing financial services, and that's where they would get their revenue from. So that revenue and on their financial statements, you could be seeing it recorded as total income or something of the sort. Really is the amount of money they've been able to make over a period from the services they provide, but also any form of contracts that they have with their customers or clients. Or if you had your own business, how much money are you making in terms of income over a period? Now, net profit really is at the end of the day, after you've made that money, you're definitely going to spend that money. A company has stakeholders, and you can't see how a company interacts with these stakeholders from the income statement. Number one, you have suppliers. Really, those suppliers you're paying for items that you use to provide services to your customers, be it operating related expenses, be it administrative related expenses. Maybe if you are a tire manufacturer, you're buying rubber from um, from your suppliers. If you have employees, you're paying staff, admin expenses, you're paying for office supplies and the like. So you're interacting with many stakeholders, and in this case, you have your suppliers. The other form of stakeholders that you have that you still have to pay before you proceed to make a profit is if you had loans or any kind of liability with a bank, you borrowed from an individual, you're paying that money back in form of interest or to your debt holders. So you will see a finance cost or an expense for that money that you're using to run your business. And then the other stakeholder is the Uganda Revenue Authority. Of course, you have to pay your taxes to them in form of corporation tax if you're a company. So from the top, you have your revenue, you pay all your stakeholders and the staff and the like, and what you're left with is your net profit, really. And that's what is now available for the owners of the company who are the shareholders. Thank you.
Oh, thank you very much, Isaac. That was very detailed. Now we know just because there's a lot of revenue doesn't mean there's stakeholders that don't need to be paid. And the profit is what we get after all that has been done, the operations and all the stakeholders have been paid. Maybe the next question goes to Dale. Dale, Stanbic's non-interest revenue grew 21% and now makes up a large share of their income. While net interest margins came under pressure, how do you explain this revenue mix shift to shareholders? And is it a sign of strength or concern?
Thank you for the question, Michelle. Good morning, everyone, again. So I'll start by giving a direct answer. You ended your question with is it a sign of strength? Yes, it's a sign of strength. Why is that? The explanation or the answer lies in the way Stanbic Bank specifically makes money. So at the bank, we make money either through our net interest income or our non-interest revenue. So when I say net interest income, think of how your typical bank lends out money to an individual for a mortgage, to a business for working capital, and we earn interest on that money we lend. In addition to earning interest on the loans, when you come and, for example, open a fixed deposit or you have a saving account with us, we would pay interest on your deposits. So what we earn is the difference between those two. So the interest that we've earned on loans and then the interest we're paying people who are depositing money with us. Over the last 2 years, what we've experienced, and this is industry-wide, is that interest rates have been going high. So some of you might have benefited if you invest in bonds, also if you invest in unit trusts. With that interest going up, what we've experienced is that customers are demanding higher interest for their deposit. So the interest we pay out on fixed deposits, for example, is going up, and yet the interest we're charging on loans has stayed flat for the most bit. One of the drivers of that is the central bank rate, which last year was flat the whole year at 9.75. So what the banking industry is experiencing is what we're calling margin compression. We're paying out higher interest rates, and the interest we're collecting are staying at the same level, so that net interest income has become small. However, specific to Stanbic Bank, we've also grown our non-interest revenue. And to explain what that is, I can give an example of if you're buying land, let's say at 50 million, you might have to send that money to the person you're buying the land from, and they want it immediately. So you choose to use RGTS, which is a real-time transfer. We'll charge you 11,500 for that. So that transaction revenue, the fees and commissions, maybe brokerage fees from our brokerage business is the non-interest revenue. And with that non-interest revenue growing, like Michelle has pointed out, we're able to diversify our business. For example, if we're a business that was reliant only or majorly on the net interest income, maybe Calvin would not have been talking about a 590 billion figure and something smaller, but we're able to ride I would say the waves of margin compression and cover for that experience with our non-interest revenue. So it's a good thing. Interest rates and how they change is cyclical. So over the past 2 years, they've been high. This year, we've seen them starting to go down a bit. We're expecting oil at the end of the year or early next year. So maybe that will also lead to interest going down further. So maybe next year it will be a different story with our net interest income going up. But the bottom line is that we are a well-diversified business. So as we experience the different pressures in the market, having multiple revenue sources or streams, it helps us manage that pressure. So again, it's a sign of strength, and I think shareholders should be happy about that.
Thank you so much, Dale. As you've heard from Dale, it is a sign of strength that the non-interest revenue grew by 21%. It shows a well-diversified business. Maybe just another question to Calvin. Using Stanbic as an example, what does the gap between what customers have deposited and what has been lent out tell an investor, and how does the bank manage risk and its liquidity?
Thank you, Michelle. The gap between the money lent out and deposits. As I said, the bank uses deposits for onward lending and investment. That's how the bank will be able to make money and maybe develop more services and like. If that figure, I believe, if that figure is so high, then it's becoming dangerous because the bank may not be liquid and may not have money for withdrawing and other operations. So if that number is too high, then it becomes dangerous for the bank unless the bank's non-performing loans are very, very low and maybe which I can't say that is supposed to signal danger, but if the NPL is so high, then it's signaling danger. But if it's low, the bank could push it to 80-90%, depending on how much is withdrawn daily and how they are managing their cash reserves at the bank. So that figure may not cause danger if that is managed well, but it shouldn't be so high simply because any given day we don't know how much money can be picked. And also the bank will always make money on the spread between what it's earning from the loans, the loans they are giving out, the mortgages, and the mortgage is a liability to what you on the asset. But yeah, basically it is supposed to be managed well, and I don't think that should be a very dangerous signal if the loans are becoming many, because if the loan book is growing, it means the bank is also making more money on that end. So it's just the bank should always look at what the NPL is saying and also grow the loan book in line with that. Michelle?
Thank you so much, Calvin. Now you know how the bank manages risk and how it manages its liquidity. And if the bank has a growing loan book, that means the bank is growing, and because they're making money on that end. The next question goes to Isaac. Stanbic posted a return on equity of 26.8% and a non-performing loan ratio of just 1.7% against the risk appetite of 7.5%. In plain language, what do these two numbers tell an investor about the quality of the company?
So I think I'll start with the first one, which is the return on equity. The word equity basically, in basic terms, means ownership, really. So return is really how much have you yielded, or how much do you get per unit for your ownership. Now, where it's calculated from is the total shareholders' equity vis-a-vis the net profit, or what stays behind after you've paid all stakeholders, made money and paid stakeholders. So your net profit over your shareholders' equity as a percentage. So that number can be affected by the size of the shareholders' equity, which in essence is what the capital, what part of the capital that the company is using to really run the business or to make money. But shareholders' equity is really what belongs to shareholders or the owners of the company on a book value basis, or what you would say on what is on the balance sheet. So that return is vis-a-vis the net profit. So really, if you start to see a number higher than 15%, a number higher than the cost of capital for the company, that's when you know that this business really is making a return for its shareholders. So the higher that number is as a percentage, the better it is for you as a shareholder. So because basically that is what you own, and from that is where comes cash flow in return of in cash flow in terms of a dividend, but also if a business needs to reinvest in its own operations, that's where part of the money or the capital is going to come from. So it's a very important number and one you have to look out for as you get to review or see financial statements. Now, non-performing loans ratio, really it's the non-performing loans, or those loans that you've given to members of the public or businesses, or money you've lent out to borrowers that is not being paid back, or that you have a chance of not getting, a very high chance of not getting back this money. So loans that are not being serviced as they should be serviced vis-a-vis the entire loan book. So from a banking perspective, if that number is very low, then you understand that because as Joe mentioned, the bank lends out money or gets money from its depositors and lends out that money. Now that margin is what they make in terms of a return or income. So if you find that the non-performing loans are growing, then that margin could be at risk or could be brought down on that. And that means really as a business, they might not be making as much as they need to. So the lower that number, the better, or the better for you as an investor to know that, oh, management is doing the right kind of work for me as a shareholder. So those are very two key numbers to look at as a shareholder from a banking perspective. As a shareholder, what is your return on your investment in the business? And then from an non-performing loans perspective for a bank is how best are they managing their borrowers so that the margin they are making of those loans is fully realized and retained. Thank you.
Thank you, Isaac. So now you know what the return on equity means and whether it's a good thing for the loan ratio to be low or high, specifically for bank businesses. The next question goes to Dale. Dale, Stanbic is paying out 360 billion in dividends for the financial year 2025. Walk us through how a shareholder finds out what they will receive and when they will receive it.
Thanks, Michelle. I think before I walk you through that process, I'll just go back to something Calvin said when he was presenting the income statement. He mentioned how when you look at the profit of 590 billion or the profit of any company, you should always ask yourself as a shareholder, how much of that is yours? How much of that are you getting? If you look at our dividend of 360 billion, that's 61% of our profit. So I just wanted to highlight that specific to Stanbic, we pay out 60% of our profit, or at least we did last year, and it's a high earnings for shareholders. How they would find out what they're getting, maybe I'll start by saying last year and over the past years, we've been paying two dividends. So we pay an interim dividend and a final dividend. After we finish the first half of the year, we look at our financials, and depending on the performance, the management and the board can decide whether or not we should pay out a dividend. That was the case last year. So after deciding that we should pay out a dividend, as a listed company, we have to adhere to the USE, the Uganda Securities Exchange listing rules. So that requires us to, one, communicate to USE that we have decided to pay a dividend. We are then obligated to come up with a dividend notice. So that is something that we circulate in the daily newspapers, so Monitor, New Vision. We also circulate it on digital channels like our website. USE, that's our regulator and a partner, also helps us circulate that, as well as the different brokers. So typically as a shareholder, as far as an interim dividend is concerned, you should see a notice in your newspapers, over email, on our website, on the USC website, and that's saying, we're going to be paying X dividend for a period of time. So we'll say, maybe a dividend of 2.73 for the first half of the year. It's an interim dividend. We then have the details of, this is the book closure date, which is the date by which you have to own shares in order to receive that dividend, and we also give you the date that we will pay the dividend. For the final dividend, if you're a shareholder that attends the AGM, the annual general meeting, we announce it there, and we also ask for your approval to pay that final dividend. As Calvin mentioned, many times shareholders approve, I think 100% of the times, but maybe we'll be surprised in the future. And we then also follow the same procedure of coming out and announcing, this is the dividend that's been declared and it's been approved. This is when you can expect to receive it, and these are the book closure dates and other details. And yeah, that's pretty much how you would find out you are going to get a dividend.
Thank you so much, Dale. So I hope shareholders are going to be on the lookout on all the different platforms that he has mentioned to know whether how much they're going to get from their shares in Stanbic. So the last question is going to go to Isaac. Isaac, what is one of the biggest myths about financial reports that stops everyday Ugandans from reading them? And what is the truth that every investor in this webinar should walk away with?
I think I'll start with truth first because it's the most important thing. Financial statements or reports really are supposed to give you a story of how management is performing, given the fact that you gave them the right, or you gave it not the right really, but you gave them the mandate through your investments to run the business in a particular way. So a financial report really is a report card per se that management used X amount of money, invested in X amount of products, and was able to get X amount of returns. This is what the future is likely to look like for this particular company. The company is a going concern, or it's going to exist over a long period of time. The business is being run the right way by the right people, and you know that your investment is safe and are growing because money is really meant to beget money. So that is one key takeaway you should walk away with. And it's very important, extremely important as an investor, that even before you buy a stock, look for annual reports, financial reports, read through them, understand who is managing these companies, how are they managing them, what are they returning per annum. The naming of those particular lines on the statements might be a little intimidating, but over time, if you use resources like the internet, you can be able to understand, oh, this figure actually means this, and then gradually or step by step, you get to understand or analyze deeper what these figures essentially mean to you as a shareholder, and whether you should go ahead and buy the securities or the securities or equity or shares in this company and be part of their shareholders, or in essence their stakeholders. So really that's it. The thing I would like to call a myth is it's very complicated. It is not. You learn gradually, and then you become a very informed or well-informed shareholder or investor. Thank you.
So as you've heard, it's not a very hard thing. You should continue educating yourself on what these terms mean and how to read financial reports, because they are very important in your investment journey. We always say an investment made in knowledge is the best investment you can make. So this marks the end of our webinar. I hope it was insightful. I hope it was productive and you are able to learn. Maybe Henry asked, how do I continue investing? How do I buy more shares? You can buy more shares through the Easy Portal, through your SCD account. For people who do not have the Easy Portal or the SCD account, please you can go to the USE website and create an SCD account, or as Calvin earlier mentioned, dial *165 *65 hash on your MTN, or *185 *85 hash to access the USE services, how to create a platform, and maybe just a few questions. There's some questions in the chat. If you have more questions, please continue adding them to the chat. So far we have a question about how the financial statements affect the share price. Maybe that one I'll ask Calvin to take that one.
Thank you, Michelle. Basically, the financial statements show you financial health of the company, and basically that is performance. And I remember the market reacts to performance of any company. The better the company performs, the more demand. Because if a company is performing well, we expect that also the dividend is growing year on. So it means that that company will become more attractive for you to buy, because in essence, we usually tell people that buy the business, don't buy the price. If the business is doing great, then it means that there's as Isaac said, there's a going concern in that business, so it is more profitable. So in the future, it's a better company to keep hold on to. So that will guide you that you should keep investing in this company. So you should look at the numbers, and the numbers will tell you where the company is going. So you're going to make, if you're focusing on earning a dividend, then you have to pay more close attention to the numbers.
Thank you so much, Calvin.
And maybe
said,
to add, if you look at the management articulation in the statements, they show you what an outlook is. If you focus on the CEO's message, you should see where the company is going, the future, and the outlook of the business, and where the business is focusing, and you will be able to see that there is growing concern and all that. Thanks.
Thank you so much, Calvin. That is very insightful. He said, buy the business, don't buy the share price. So look at how the business is performing, and that's what will reflect in the price. The next question is, maybe I'll direct this to Isaac. How can an investor see through the stories that a company put in reports to paint a better than true picture of the business? Are the company reports enough? Is there another place to look?
All right. Usually a company issues or releases financial statement first, but those follow investor presentations. So that is also another important session that you should always look out for, and be part of, or what you would call investor briefings. I think Stanbic had theirs. They presented what the financials look like. They give you a glimpse of not only the numbers but also strategy, because really a business is a story. You invest X amount, and that can be seen on the balance sheet. You make X amount, which can be seen on the income statement, and then you contribute to stakeholders or the public, and that can also be seen on the income statement. But also, you look out for annual reports, usually ahead of an annual general meeting for shareholders. An annual report is released. Now, within that annual report, you find more information around the company's performance, management discussion and analysis. You find what they're doing in terms of ESG or environment, social and governance initiatives. I think that has become a very important part of our society. You get to see that information there. But there's other sources, really, newspapers on a daily basis. If you look out for them, or stories online, you get a glimpse that, oh, maybe this is what the company I invested in is doing. So there are various amounts of various sources of information that you can look out for to paint your own picture, because it is a story that yourself can get from what other people are telling you. You can always deduce and understand that the reason I'm investing or buying shares in Stanbic is because of A, B, C, and D, which you get from the information you find as you go along. But the financial statements give you a very key, they give you the actual numbers that this company is being able to generate. Thank you.
Thank you so much, Isaac. Maybe two more questions. Someone asked, What determines a company's per share price increase or decrease? I think Calvin can take that one.
Thank you, Michelle. For price, for most markets in the world, it's demand and supply that determines the share price. Unless there's an adjustment to the price, maybe if there's a bonus issue and there's a price discovery and the like, but it's always demand and supply that determine the price. So willing seller, willing buyer. That's how the price is determined. That's why I say that if you come to place an order in the market, we always tell you to quote a price in the market. Although we have regulations to setting price on the selling and buying, which the USE has always guided, it's 10% up or 10% down of the current price in the market. Thank you.
Thank you so much, Calvin. So this is the final question, and it's going to go to Dale. Someone is asking, could we see Stanbic pay dividends per quarter in the future?
It's possible. It's something that I can't commit to. When we make our dividend decisions, we take into consideration a number of things. So, for example, I guess the first one is our performance. How well have we done? 2, the money we need to meet regulatory requirements. So, for example, our biggest subsidiary is the bank. We need to have a certain amount of money seated with the central bank to remain a tier 1 bank. The same also applies for our fund manager, SBG Securities. So we need to look into all our cash requirements and then we come to that decision. Right now, we are able to comfortably do so with the half and the full, but as the business evolves and as our cash requirements evolve, we can look into that as well. But it's something we can't commit to.
Thank you so much, Dale. Maybe we can just end the webinar. Okay, Susan, do you have a question? Susan, you can just put your question in the chat. Maybe we'll have a platform on which we can answer all the other questions that were asked. And there'll be more trainings on these, more webinars on a variety of things that will be talked about with regards to investment and what that looks like, as well as more crucial matters with regards to investing and how to know where to invest, basically financial literacy through the USE Academy. So watch out for more webinars, as well as more comprehensive classes that will be advertised. Maybe just for more information on that, I can just ask John to give us details.
Yeah, thank you so much, our moderator and the speakers for being part of, and of course, most importantly, the participants for being part of this webinar. We'll be sending a communication in terms of our next webinar, but I've gotten your feedback in terms of time being insufficient for this particular webinar, given that it's financials and need to be as practical as possible. So for the questions which we haven't answered, we'll send you the recording of this session. We'll also send you the answers to those questions, and also most importantly, a communication on when our next webinar will be taking place and the topic, which of course will happen on the last Thursday of this month. Thank you so much. We once again appreciate you for being part of this.